Treasury Select Committee on Tuesday, the 20th of May 2025. We're pleased today to have in front of us four of the largest banks in the UK, or representatives. So from my left to right, we have Paul Thwaite, who's the Chief Executive Officer of NatWest Group. He's next to him is Vim Maru, who's the Chief Executive of Barclays Bank. Then Ian Stewart, the Chief Executive Officer of HSBC. And Charlie Nunn, the Executive Director and Group Chief Executive of Lloyds Banking Group. So a welcome to you all. We're very keen to hear what you've got to say about a range of issues. So we're going to be cantering through quite a lot of topics and hope that we'll have you as regular visitors to this committee. So I'm going to ask Bobby Dean MP to kick off. Mr. Dean.
We're going to kick off on motor finance, and Charlie Nunn, it makes sense probably to come to you as the sort of largest lender in this market. You've made a £450 million provision for compensation, and we're obviously awaiting the Supreme Court decision very soon. If the decision is upheld, what impact will that have?
Well, first of all, thank you for having us back to the Treasury Select Committee, and thank you for the question, Mr. Dean. As you say, we've made two provisions, actually. One was a £450 million provision last year, which was with respect to discretionary commissions that the FCA was looking into. And then we made another provision this year for £700 million, which was linked to the Court of Appeal decision. And obviously we welcomed the Supreme Court looking at that decision on an accelerated basis. We're expecting, I think, the Supreme Court's guided they'll come back in July with their view around whether or not they will change or support the decision of the Court of Appeal. And then depending on that, the critical next step, which the FCA is committed to, is to look at whether there were harm based on whatever is the findings from the law courts, and whether there's an appropriate remediation programme to be put in place. And that's really important for us to then respond once we have that clarity.
And assuming that the judgment is that there has been harm and the FCA decides to proceed with the redress scheme in the way that they've announced, can you describe what impact that's going to have on the market?
Yeah, so I think it's really important just to say, obviously, car finance is a really important market, both for the automotive industry and also for consumers. About 80% of people need financing for buying a new car, about 50 to 60% for a second-hand car, and that's why it's such an important industry to get clarity on. As you know, less than 70% of people have even more than £5,000 worth of savings, so they can't afford cars without financing. At this stage, we don't have evidence of harm. That's not been one of the things that's been focused on. Or in fact that we've broken the regulation retrospectively, if those things were found to be true, of course we'd then lean in fully to try and identify the customers that did experience harm as defined by the FCA, and then support a remediation programme. I think just stepping back out, the really important point for me is how do we provide clarity to customers? How do we provide clarity to the industry and then enable the industry to continue to perform a function? And that's really important as we look at the next 6 and 12 months to provide that clarity. Without clarity, it will create dysfunction in the market.
Do you not think that you might just be hiding behind a legal definition of harm here? Because I noticed you said just now that you're not sure if there's evidence of harm. I know you said at an industry conference recently the same thing. But I've met with constituents who feel like they really have been duped. There was advanced commission payments paid they weren't aware of. They were trusting their broker as an honest broker who was acting in their interest. They were told that this was the best possible deal they could get, but when they dug beneath the surface they found out that they're paying sort of sky high interest rates, and they probably could have got a better deal elsewhere, but they had to put their trust in that honest intermediary. Do you not think that kind of activity is harm?
So obviously this industry was operating for decades under a regulatory and a legal framework, as you know, and the last time there was a review of it was in 2020 when the FCA looked at this.
But back to the individual case, so my constituent who I met with, who depends on their car to earn a living, they had to lend. It wasn't a brand new flashy car, but a second-hand car, but they still needed to finance it. The credit history is not great, and they have to trust that intermediary. And that intermediary, without them knowing, without the consumer knowing, is receiving huge advanced commission payments from the lender. That's obviously going to make that intermediary work in the interests of the lender and not the consumer. That's harm, isn't it? That's consumer harm.
So I've had a chance to look at a lot of individual cases as well, and obviously, as you say, the specifics are in the individual cases. One of the things when we look at those cases is the dealer is trying to look at 4 things. They're trying to create the right package and value for the customer. There's typically a trade-in, so the trade-in value of the car. There's typically a new car that they're buying, and so what is the price they pay for the new car? If they need financing, what the cost of that financing is, and then finally value-added services. So do I get paint protection? Do I get valet service on an existing car? That's what the dealer is putting together. And when we look at the individual cases that we will obviously look at, I've looked at them looking back, but as we get clarity from the Supreme Court and the FCA, it's looking at that combination of factors that determines whether or not a customer actually got the right package and the right deal, or whether there were harm. And as I said, at this stage, we haven't had evidence of harm, although if it were identified, of course, we would lean into it.
But when it comes to the lending element in particular, and they are trusting them to act as an honest broker, this is not the same as chucking in some car mats or, saying there's a sat-nav included. This is about a financial arrangement where they're kind of trusting the intermediary to be an honest broker. If there are things like advance commission payments being paid, I mean, maybe you can confirm to whoever Lloyds were engaged in that practice too, of paying dealers advance commissions. How can that possibly be an honest deal?
So, first of all, yes, Lloyds, through its Black Horse subsidiary, was working on discretionary commissions until 2017. And then it changed its approach going forward. And obviously in 2021, when the FCA did its review, the industry stopped two-way discretionary commissions, which I think is the core thing you're looking at in that context. So that does exist. It's a very proven practice in this industry and actually some other industries. And again, when you look at the value that the customer is normally exchanging, average price of a first-time car is £27,000, average price of a trade-in is very significant. The value that the dealer is talking about is a very significant value package. And of course, the commissions go to the dealer, not the customer. So there's a set of standard practices. The regulators have reviewed this. We will obviously look at it. And if there were to be any findings looking at this, then obviously we would look at that and look proactively to support our customers. The interesting challenge, of course, is when you stand back and say, how do we ensure clarity for customers and then make sure the industry can continue to function? A really important industry, both for the automotive manufacturing industry and then the dealers and the car network in support of customers. Getting that clarity is really important. And this kind of uncertainty where we have 30 years of regulation, where, for example, the Court of Appeal seems to be at odds with 30 years of regulation, creates massive backward-looking uncertainty and investment in the industry, and actually real uncertainty around investment in the UK more broadly. So, we welcome the Supreme Court. We definitely welcome the FCA then stepping in, and our hope is if we can get that clarity, we can then move forward and focus on the individuals, which is really the important part.
Final question, because I know, in interest of time. Obviously, one decision is clear. You mentioned that around discretionary arrangements, and there's been a fair amount of understanding what might happen next. And so you might expect lenders to have already baked those in. As far as understanding, the market's still operating fine. Do you think that market would be heavily disrupted if the court was all of a sudden to uphold a decision that lots of lenders already are kind of half aware of?
Yes, it is interesting that the industry has put in place the full disclosure on commissions, and we've seen no material change in customer behaviour. I think that's a really important point, so thanks for noting that.
I guess my question is there really a threat to the market by this decision being upheld? Because it seems like the market's already adjusted.
It will all depend on the specifics of the decision, and it's a very broad range of scenarios we've looked at. There's 3 or 4 quite technical points of law that the Supreme Court's looking at. And then, depending on how the FCA then looks at those legal findings and how that interprets it, and then depending on how customers and the professional representatives of the claimant law firms respond, there is quite a broad range of scenarios. Some of them very much could disrupt the industry. Lloyds Banking Group is in a very strong position, but some of those scenarios are difficult. So this next 6 months or 12 months, depending on how long it takes for the FCA to fully respond, we think are really important for customers to be able to get credible financing, for the industry to operate, for the dealer structure to work, and for the UK to remain investable.
Okay, thank you, Joe.
You're right. Just brief on that, Mr. Nunn, your accounts last year showed you set aside £450 million in potential provision for the impact of the FCA review and compensation. And I just wanted you to clarify, because I'm sure some of my constituents who are listening, who may have been caught up in this, will be really surprised to hear what you said about harm. At the same time that your bank is setting aside quite a large provision for compensation, you're also telling those customers, former customers of yours, that you don't see any harm. And I think it would be good if you could clarify what you mean by that.
Yeah, thank you, Ms. Yang. And it does look like the two things don't fully align at this stage. So the accounting provision we need to take, which I have a legal obligation to make sure I follow my accounting rules, say that you have to take a best estimate when something becomes more than likely. And that £450 million provision incorporates two things. One is the operational expenses of responding to claimant law firms, of which we've had a very, very large number of complaints which aren't even our customers. So we know there's significant operational expenses of processing and trying to help customers identify if they even had a policy with us. Very high percentages of that. So processing the operational complaints, supporting the customers, and then if there were remediation linked to harm, paying out remediation. We haven't disclosed actually the split between those two things, but we have obviously experience, and the operational expenses are very significant. So we know, just based on the actions that the FCA had announced, that we were going to incur significant costs. So from an accounting perspective, we are legally obliged to do that. That's not linked to the decisions that the FCA and the Supreme Court will take around both were there a breach of the law, and then were there harm, and if there were harm, is there an appropriate remediation that should be made? All of those steps are independent of the accounting provision, and I know that probably isn't helpful for the public, but that's the basis on which we make those decisions. Probably one final thing is, and my CFO has obviously gone through this in some detail, when you look at the underlying of that provision, what we did look at was a range of scenarios and then probability weight them back. So we have said repeatedly, this is our best estimate. It could be zero, and there is a scenario that's zero, and there is a scenario that could be higher than 450. And until we get additional facts, specifically whether or not there was a breach of the regulation, whether or not there were harm, and then what the FCA decides, if those two things are true, for a subset of customers, what kind of remediation, we won't be able to clarify the number.
And we've also seen a lot of adverts already for people saying, you know, if you bought a car, to give us your details and we'll pursue a claim. And when the PPP issue arose, there were a lot of you were employing a lot of people, not just you, but other financial institutions, to chase down whether that person had ever had an account with you. Can I just go through in turn what you're doing to resource that? I mean, you've highlighted that some of that money that you've set aside, or you've made provision for, is for that processing, but a lot of that was dead weight processing that it was quite people were speculatively putting in. And have you each got an idea of what you're going to have to set aside? So, Mr. Nunn, you've really answered that. Mr. Stewart.
Yeah, thank you, Chairman. So we're not involved in the motor finance industry.
So it's not an issue.
So, well, very, very low, very low. We have had some customers writing in, but we've got that well covered.
Okay.
The only point I would add is that our investors are very interested in the outcome.
Yeah. Okay. Mr. Murray.
So we exited the motor market in 2019. We had a low market share prior to that. We have had customer inquiries as well as inquiries from claims management companies, as Mr. Nunn talked about, and we have sufficient resources to deal with those. The harder ones are to deal with cases which are 10, 20 years old, and that's obviously where a lot of effort goes into trying to find those policies as appropriate.
So have you got staff dedicated already to
We do.
this? Okay. How many?
We have a few hundred staff dedicated to this to try and deal with the processing, but also in preparation of the Supreme Court decision to make sure that we have sufficient resources when further incoming inquiries from customers come in after the Supreme Court.
Okay, and Mr. Thwaite?
NatWest, we don't have a direct-to-consumer motor finance business, so we haven't put any additional steps in place.
So Mr. Thwaite looking relieved at the end, Mr. Stewart, compared with Mr. Nunn. Thank you very much indeed. John Glenn, MP.
Thank you, Chair. In this section, I want to look at growth and regulation and try and hope by the end of it get some clarity over what you think can be done. In the Mansion House speech, the Chancellor said that after the 2008 financial crisis, that it had resulted in a system which sought to eliminate risk-taking that had gone too far. Yet Sam Woods, when he came before us, he said that the big planks of post-crisis reform, such as bank capital, bank liquidity, capital, insurance companies, and the types of responses that we have on CEOs of big firms, there's no convincing evidence that has been overdone. There's a bit of a contradiction there. I won't want to draw you on that. But I think the whole country wants to understand what is it you, as CEOs of our biggest banks, need and want in terms of regulatory reform specifics that will move the dial in growth terms?
Do you want to start? Should we start?
Start with Mr. Stewart, please. It's good to see you again.
Good to see you.
In a
Mr.
different
Brown.
role.
Yeah, so well, first of all, we have written on this matter on ring fencing, and what we've asked for is a review. So I was the CEO of the bank just before ring fencing came in, so I've seen it end to end. And the rules for ring fencing were written back, I guess, 2012, maybe 2011, 2012, 13 years ago. And we believe that by reviewing some of the rules, or to review ring fencing in its entirety, would be a good step in the right direction. So let me just give you one example. I could give you many, but I'll give you one example. Today we've got two banks in the UK. We've got the UK ring fence bank, which does the bulk of the lending, and we've got the non-ring fence bank. Today, we can't move liquidity or capital across the banks because they're separate entities. Liquidity is a particular issue. So if you're a US bank in the UK, you can raise up to £35 billion from retail deposits, and you can use that to invest back through your bank, your corporate and your investment bank based in the UK. We cannot do that. Just that simple act of being able to move liquidity around would put more growth, oxygen into the economy, and I think really help businesses in the UK today. It's just one example.
So, ring fencing, and the PRA would say that, of course, they have all the tools to deal with any major disruption risks, but the argument sort of goes that this is a legacy of comfort that the country has and needs with respect to knowing that there's not going to be sort of contamination from casino activities into our mainstream banking sector. So you would say that that is a sort of redundant, out-of-date concern that no longer is meaningful, and indeed by maintaining it, you know actually stops you from doing the best things you can with the money that you have available.
So I think there's 2 points on that. I've always thought that ring fencing was brought in at a point in time for a very good reason, which was to protect taxpayers bailing out banks.
Yeah.
I have no issue with that at all. What's since happened is that ring fencing has got more elaborate, there are more controls in there, and so I sense that we are overcapitalised, we've got too much liquidity, and there's only so much we can do with that. I really think a review now to try and recalibrate that so that you're putting more oxygen into the economy would really be timely.
Okay, thank you, Mr. Stewart. Now, Mr. Mario, I think you'll take a different view because Barclays Capital is an entity that you've worked up over time. It's separate, it's distinct from the other three banks here. Do you disagree with Mr. Stewart? Is that right? And why do you disagree? Because isn't it just the convenience of your own company's personal sort of corporate journey over the last 20 years?
So let me try and just sort of, I guess, talk about ring fencing, and then maybe I'll go broader to your broader question as well in a second.
What's not compelling in Mr. Stewart's logic?
So like Mr. Stewart, we have a ring fence bank and a non-ring fence bank.
Yeah.
But I think when we go back to the logic of ring fencing, global financial crisis, £137 billion of taxpayer support, that's the origin. What has it led to? It's led to financial stability, it's led to depositor protection enhancements with the separation of the retail business from the non-retail business, and it's increased trust in the sector. What we've seen in the last couple of years is some financial issues across the globe. We've been more immune to that, and I think that's because we have ring fencing. Could there be enhancements to ring fencing? Absolutely, and we've had a review recently. The implementation of that happened in February this year, so only 3 months ago. Are there further opportunities, like examples that Mr. Stewart talks about? Of course, there may be further enhancements, and those should be looked at by the PRA case by case. But repealing ring fencing, we don't think is the right way forward for the reasons I just set out.
But if the PRA have got the tools at their disposal to deal with any crises that may exist with unforeseen circumstances, why does the logic of 16, 17 years ago still prevail? Because a lot has been learnt, and lots of other tools around, you know, the capitalisation of banks and the different mechanisms used to, you know, keep the banking sector secure have been implemented. So again, isn't it just really the case that you institutionally have developed a different profile, and therefore you've got a commercial advantage to maintain it as it is?
I think the key points are that we've chosen to implement ring fencing in a certain way. everyone has that available to them, how they deal with shared services, how they separate the ring-fenced bank with the non-ring-fenced bank. Those are available. And then to your other point, there are tools that are available, but they all complement each other. Ring fencing is one tool, resolution is another, the capital framework is another. They all complement each other and that jigsaw comes together. Of course, if clarification is needed, that should happen.
Okay, thank you. Mr Nunn, could I come to you? Do you agree with more with Mr Stewart or Mr Maru? And are there other things beyond ring fencing that you would like to see happen that would be helpful for growth in your sector?
Thank you, Mr Glenn. Simple answer is I agree more with Mr Stewart. Just one other additional point, which I think is obvious, but it's important. We think it's right to look at this strategically because this would probably require primary legislation if this were to be a government policy. That would take a couple of years. It would take another 5 years to implement. So this is about setting up the UK for a healthy economy needing a healthy financial system for the 2030s. This isn't about growth in the next 5 years. On growth in the next 5 years, we really do think there are some important things to look at. We really welcomed the secondary competitiveness and growth objective. And what we're seeing with the PRA and the FCA is they're really leaning into that with this new government. And we would look at it slightly differently. We identify a number of areas, whether it's helping the housing market, helping first-time buyers, scale up financing for SMEs, helping people take the appropriate level of investment. And when we look at those kinds of themes, we have about 10 of them we think will make a real difference to people, businesses in the UK. It's typically a combination of both prudential and conduct regulation that's stopping us serving customers and financing more to enable growth. And so let me just give one example on mortgages, which is probably the one you'd look to me in SME.
Loosen the lending criteria. I think that's well understood.
Well, I think it's even more than that. So if you look at capital models, we have to include data on mortgages from 2000 to 2008, which don't even exist in the UK market. So we have higher capital levels, we have higher capital for first-time buyers, not linked to risk. We have conduct standards that have been looked at recently with the FCA, and we really welcome the review that the FCA is doing more broadly. And then this economy has about £8 trillion locked up in real estate, and it's very hard to unlock it for customers. So, and the conduct regulation prevents that. So I think there's a real opportunity to say, what do we want society to do around these really important themes, and then let's just get the right regulation around it.
Okay, thank you. I'm being pressed for time because we've got territory questions, we've got a hard stop today. Mr Thwaite, is there anything you'd like to add? And first, for clarity, could you describe your position on NatWest's position on ring fencing?
Thank you, Mr Blair. Very clear on ring fencing, align with Mr Stewart's position. What I would add is the developments since ring fencing on the prudential side, on the resolution side, on the financial services compensation scheme, I think provide the necessary protections. Nobody wants to jeopardise financial stability or consumer protection, but I think those protections are in place, and the current regulations run the risk of getting in the way of customer activity, which ultimately is about UK economic growth. I'd agree with Mr Nunn's comments on the opportunities. I think we have to look at both the prudential and the conduct side. On the prudential side, the final capital package, call it Basel 3.1 or Basel 4, I think it's important that supports the real economy, SMEs and infrastructure. It's important that it aligns internationally. I welcome the deferral until 2027, but it'll be important to understand where both the EU and the American authorities settle. And on the conduct side, I think there's lots of opportunity to look at mortgages. I'm particularly interested in the wealth advice review. I think it's crucial that customers have more access to financial advice. We know collectively there's a challenge there, so I welcome that review. The review of the rule book, where there's lots of duplication and overlap. For example, some small examples around consumer duty. So I welcome the broader approach that the regulators are taking. I applaud them embracing the secondary objective. I think it's important the committee understand a lot of these topics are at the consultation stage. So if the desire is to move forward and create growth, we need to move from consultation into action.
And my final question is related to the other side of it and what your view is about what the FCA in evidence the Lords described as tolerable harm from a consumer point of view. How should we, as a committee, view that conundrum between some of the changes that Mr Nunn and Mr Stewart have set out that you agree with, and the tolerable harm that may be consequential of those changes?
Yeah, I mean, from my perspective, Mr Glenn, ultimately this goes back to customers, and it goes back to risk appetite. Having high quality regulation that protects consumers and customers is crucially important. I think there's a difference between zero risk and zero harm and proportionate and smart regulation. And I think the challenge for the industry and for the regulators and for the policymakers is to find that happy balance. But everybody wants to ensure that our regulatory regime protects customers and that banks are obliged to provide simple, clear products and services.
Thank you for your answers.
Thank you very much, Mr Glenn. Lola McAvoy MP.
Thank you, Chair. Good morning.
Morning.
So, on the 6th of May, Business Matters reported that you were going, or the big senior figures from HSBC, NatWest and Lloyds were attending a meeting with ministers to discuss the government's growth strategy and getting more money into small and medium-sized enterprises. Were any of you at that meeting? Can you tell us a little bit about it? Do you know anything about it or have any views on it?
You directed it then.
Didn't attend.
So I can start on
Thank you.
SMEs. I only volunteered to start because I'm quite passionate about SMEs. I was a relationship manager in the 1980s dealing with small businesses, and that is not yesterday. I don't think the market has changed much since then. We've got the privilege, and I use that word chosenly, privilege of dealing with about 700,000 small businesses. And that market absolutely thrives on confidence. It's a market that does really well when people are feeling confident about the economy and the future. And it stalls, excuse me, when it hasn't got that level of confidence. The good news is we are seeing quite a material uptick Q1 2025 versus Q1 2024 in lending, but I do caveat that by saying off a very low base. Now this is a market that's never been hungry for borrowing, but I'm always encouraged when I see more activity. We have just launched late last year a complete review of the way we go to market in business banking. We are going back to some basics. We're going to invest heavily in relationship managers on the ground. We think it's important to have our relationship managers close to the customers. And at the same time, we're going to automate a lot of processes behind the scenes because customers want various channels. But this is a part of the business where the decisions are made at the kitchen table, not the board table. And it's a really important sector, and I urge everyone to lean in and help the SMEs in the UK today.
Great, thank you for that. Does anybody else have anything they wanted to add on? Yeah, thank you.
I'll
Mr.
just
Murray.
add and echo Mr Stewart's points. We serve 1 million businesses in the UK, and to the point about relationship managers, we actually have 600 relationship managers all around the country serving these businesses. I think it's important for us to recognise that it's been a difficult period for businesses in the last 5 years. They've been through COVID, inflation, higher rates, and now tariffs. So spending time with these businesses, helping understand their needs and issues has been really critical, and that's what our relationship managers have been doing. The confidence levels have clearly ebbed and flowed through that period, and we continue to see some challenges with business confidence, but actually when you look at the hard data, to the point that Mr Stewart made, we're starting to see really good growth in lending, which means that some businesses are starting to take decisions about the future opportunities and growth as well. And I hope that over the coming months, as more certainty comes into the system, that more and more of them will continue to do that.
So do we. So can you give us a little bit more detail on that, those positive trends? Any more, some of the figures about that? What are we talking about?
So I can talk a little bit about the sort of the lending numbers. What we've seen 24 versus 23 is an uplift around 35%. And then we've seen that increase further in the first quarter, as Mr Stewart was talking about.
Great. And is that specifically to SMEs?
That is specifically to SMEs.
And so it won't surprise you, I'm sure, to know that I'll be interested in the regional disparity point on this. But before we get to that, does Mr Nunn or Mr Thwaite, do you have anything you wanted to add on?
Well, in terms of data, that might be helpful to the committee, Ms McAvoy. The only thing I'd add, and I agree completely with Mr Stewart and Mr Maru, is we've been running a business sentiment survey for 15, 16 years now, and sentiment and confidence has come down in the last couple of months as we've come into the increase in taxes in April. We've got the tariffs and the uncertainty, but actually it's still higher than the long-term average. On our data, the long-term average is plus 28 points, and we're operating in the kind of plus 37, plus 38 points. And cash flows, depending on sector, depending on region, and I'm sure we'll come to that, the cash flows for the majority of small businesses, small and medium-sized businesses, have continued to strengthen year on year. So there's some tough choices being made to enable that, but there is the resilience in this sector if we can get the confidence and we can get the plan for growth, just as there is in households, which maybe we'll talk about later.
Excellent. Mr. Thwaite?
Similar trends, significant increases year on year in SME lending from a NatWest perspective. We bank around 20% of all startups, so we feel we have a really good view of, the health of the SME nation. We also do a regional kind of tracker survey. Sentiment has dipped since the tariff announcements, but to Mr. Nunn's point, there is underlying confidence and there is underlying resilience, which is encouraging. There is a lot of supply of lending into the market. It's a very competitive market. It's not just the large banks. There's lots of challenger banks. There's a lot of specialist lenders. There's a very active broker market. But the way I think about this market is there's the supply side, but there's also the demand side. I still think there's a lot that we can do as a country to encourage awareness and understanding of the ability to access finance and make sure that policy is supportive of that banks are educating and training, and ultimately SMEs are the lifeblood of the economy. So if we want to thrive in UK economy in all the nations and all the regions, then we need SMEs to grow, we need them to borrow, and banks need to play their part in that.
So on that point of 20% of startups are with NatWest, why do you think that is? What's different about what you're offering to startups? Because that's one of the big things that's a challenge, is micro businesses are really struggling to access capital. And I think we had some data that said 5% of SMEs wouldn't consider, 5% of SMEs would consider another lender if not offered the loan amount from their own bank. So obviously that's a very small amount that would go shopping somewhere else. So even though there is a lot of supply, people are looking to their own bank.
Yeah, I think we have
Sorry.
Yeah, so we have so it's your question around, I guess, the NatWest position. NatWest has a very strong heritage in business. It's traditionally been the biggest bank for business. I recognise this isn't a competition in terms of how many relationship managers you have, but we have 1,000 relationships. So we. But the point I make is that those relationship managers really are in all the towns, all the countries, all the nations and regions of the UK. And for SMEs, it's very important to have local relationships, people who understand the local geography, people who understand the sectors in which they operate. And they get a lot of reassurance and comfort from that. There are regional differences in terms of growth patterns. I'm sure you have some of the data in front of you. I've been encouraged that we're seeing growth in a variety of areas across the UK. Northern Ireland recently has been strong. Areas outside of the London and South East, which is, although is strong, other areas are growing. Some areas are growing at a faster rate. So there's a broad-based growth that we see across the country. What SMEs want, when I speak to customers, they want confidence in terms of their bank being by their side. They want access to simple services, whether that's a relationship manager, whether that's digital services. A lot of SMEs are entirely digital in terms of the way they do their banking. So what we're trying to provide is just a broad range of services. Ultimately, business owners want to run their business. What they don't want to do is spend a lot of time on their banking. So making it as simple and as easy as possible is really the proposition that we deliver.
Thank you. So when we talk, just very quickly, because that was a note to say, keep it going. On the 20% startups, how does that, is that because you've got such a large proportion of business loans, businesses on your books, or is it because you've done a focused strategy on getting? Yeah,
we've been very focused on supporting the SME community. We have 12 accelerator hubs across the country, which provide free support to people who are starting their new businesses. It's an area where they can set up their business, they can have mentors, they can meet like-minded people who are setting up businesses. My view is we have a responsibility to support initial startups, and hopefully they'll grow into the businesses of the future.
Great, thank you, Mrs. Thwaite. And Mr. Nunn?
So very, very similar themes. I won't go down the competitive route.
Yeah, sure.
But I do feel a bit disadvantaged. I haven't done my sales pitch at this stage. But look, we have a very, very similar view. The one other thing I'd just say that we do that we think is important is provide equity finance as well. Now, many SMEs don't want equity finance, but we have one of the biggest, it's called Lloyds Development Capital, that is embedded right across the whole of the UK. Actually, its not primary focus isn't London. We support customers in London. And that's really important as well. When you start thinking about scale-up financing, really supporting SMEs at lower end, we're about 1 in 5 as well in the UK. That becomes a really important part of the dialogue, how you help them through that life cycle and have the confidence to scale.
That's definitely what we hear a lot from constituents, isn't it? The valley of death is a problem. Just on that point, so we've got government data that says that just under 50% of SME loan applications are approved. Do you think from the big banks, obviously, there's a bit of a risk problem? Are you risk averse from lending to SMEs? Has it changed? Are we, what's going on there? Mr. Murray?
I can start. So the numbers for us are 8 out of 10 loans are approved. And I've talked about the outcomes as well in terms of the growth in lending that we've seen. And we have significant available lending to offer. We actually went out and talked about a £22 billion fund available for businesses recently. And then just finishing the earlier point about startups and scale-ups as well, one of the things that Barclays has done is the Eagle Labs, 40 of them around the country, so being local, helping support scale-up. We've helped about 17,000 businesses in the last decade to raise about £4.7 billion of capital.
Great. Does anybody else have anything on that point that they wanted to add?
Just a small point. I mean, when we read some of the press commentary about acceptance rates, we really do drill into that because we think, gosh, is that us? What more can we do? We are circa 80% acceptance rate, but more importantly, I think, is that we get a lot of pushback on personal guarantees. So we've done a lot of work to make sure that we're not taking personal guarantees. So I think we're about 2/3 now of the book who do not have personal guarantees, and we think that's really important. And then the other area where we've had to go really focused this year is an SME fund for women entrepreneurs, because they could not get into business as easily, and that has been tremendously successful. So we really do drill into some of the data points to make sure we're doing as much as we can to support the small businesses of this country.
Great, thank you. In the interest of time, is that all right? I was just going to say that the challenger banks are taking over in terms of funding SMEs, and I just wondered why you think that is, and if you're going to close that gap. Maybe to Mr. Thwaite?
So I'm not sure exactly what data you're looking at, but if we take from my perspective, NatWest, we are clearly the biggest lender to business, and it's a very competitive area. We're committed to it. We'll continue to support it. We have capital available. We get very good feedback from our customers, and we're certainly not ceding that competitive territory.
Okay, all right. And just because I know that I've only got one last question, it was just about regional disparity. So obviously in the North East, we've got a smaller amount of SMEs, but we've definitely got a smaller amount of angel investors, and we really do need the big high street banks to be lending to SMEs in the North East and in Tees Valley specifically. With the government's industrial strategy coming out, do you have any thoughts about how that would give you more confidence to prioritise areas that are focused, that have growth opportunities in line with the government's industrial strategy? Mr. Nunn?
Yes, I mean, it's a really important point. And as we've all talked about, our regional presence on the ground is hugely important. We really welcome the industrial strategy. We think there is, by providing clarity and a bit of a vision around some of the sectors that will drive the next stage of our development as an economy, provide jobs and growth and employment, we can start to stitch together the supply chains and the small businesses working together with the large businesses. The other thing we spend a lot of time with is also the universities, and there's some brilliant universities in the North East which provide opportunities for spin-out companies which we can then scale. My guess is you're going to hear the same theme from all of us. So we really welcome the industrial strategy, and we really welcome working at a local level with local combined authorities, the mayors, the local communities, to stitch together those fabrics that make the supply chains and the growth happen.
Great, thank you, Mr. Nunn.
The one thing I would add, additional thing, is that I think it's crucial that the industrial strategy is looked at through the lens of SMEs and also mid-market companies. It isn't just approaching like the growth challenge or problem from the perspective of large corporates. So I think we need to ensure that the proposals work for SMEs and they work for mid-market companies, because they're the larger companies of the future.
Thank you very much. Thank you, Chair.
Thanks, Meg. As we know, both in your sector in finance and in ours in politics, once trust is gone, it's very, very difficult to rebuild. And that is why any resolution service to companies who have been missold products is as it appears. And one of the most challenging discussions I've ever had with the small businesses in my constituency is one that was destroyed by the interest hedging products that were sold. And that was going to be addressed by the Business Banking Resolution Service, which was presented as an organisation entirely independent of the banks who lent them the money and the product. It seems to be that it is now been suggested that the BBRS is an entity controlled by an entity known as the Bank Appointed Member, and the Bank Appointed Member is controlled by 7 banks, including Lloyds and NatWest. So, is the BBRS controlled by the banks? And that's a question to Mr. Nunn and to Mr. Thwaite.
Thank you for the question. I mean, the first thing to say is obviously some of the lessons of what we saw happen in the past around how we supported SMEs are really important lessons, and we obviously empathise hugely with the people that were affected by that, and there were important lessons taken through. On the BBRS, on the Business Banking Resolution Service, what we saw over the last 10 years and 15 years was that actually 2 things were happening. It was being referred to and working on fewer and fewer cases, so we were seeing it was actually doing less. And then secondly, as the new conduct rules and then the consumer duty regulation came in, we had other ways of ensuring that the right customer outcomes and then the right resolution services were being applied. And so we saw those 2 things coming together, and we thought, certainly from Lloyds Banking Group perspective, the best way we can serve customers is by investing in those broader conduct rules in support of these kinds of customers, our SME customers. We have relationships with a number of bodies, and we fund most of the bodies in the industry that provide support and regulation and oversight of the banking rules, and we have clear rules around making sure there's no conflicts. So the BBRS I would still see as independent. That is true of all of the bodies in the industry and the regulators that are funded by the industry, that we have independent ways of operating, and I think that's a really important part going forward for the BBRS.
I agree with Mr. Nunn. The volumes in relation to BBRS were very low, despite a lot of proactive communication and advertising to make customers aware of the services. I do think, Ms MacDonald, there is a couple of answers already on the record around the independence, some of the technicalities and the specifics, but as Mr. Nunn summarised, that there is a distinction between the funding of certain parties and the independent kind of governance of the BBRS. So we can re-provide that, but that would hopefully provide you with the reassurance that you wanted, that there wasn't any influence in terms of the decision-making around BBRS governance, which is different from the financing of those services which the sector agreed to provide.
Can you understand that the companies and the individuals who trusted their banks, who had a relationship, they thought they had a relationship that was built on trust and mutual benefit, only to take on a product that destroyed them and later not to get compensation, might believe that's not the case?
I certainly understand that perspective and have an incredible amount of empathy and sympathy for customers who are affected, whether it's via interest rate hedging or other. And it's critical, and I like to think the industry has learned the lessons of the financial crisis, and that the dispute resolution mechanisms that are in place now, combined with initiatives like consumer duty, will absolutely assure that there's no repeat of those activities. And we always encourage where customers have specific complaints. I know we've dealt with some in your constituency previously. Very happy to deal with them bilaterally and make sure customers have clear and succinct answers as to the issues in play.
Thank you.
Thank you.
Oh gosh, it's mine. The next section's mine as well. I can't keep up. Can I just ask the members of our panel, how has the consumer duty changed how you operate? Shall we start with you, Mr.
Mr. Happy. So the first thing I'd say about consumer duty is it feels very much business as usual now. When we last were in front of the committee, we're still, in certain respects, in the implementation stage. So it feels very embedded in the way that the organisation operates. The goal of good customer outcomes is one we're wholeheartedly aligned with. And I do think it's helped sharpen the organisation in terms of how it thinks about its customer communications, how it thinks about its product design. Some examples would be we've made over 350 changes to products and services, looking at things through a customer duty or consumer duty lens. For example, we consolidated 15 savings products into one to make it simpler and clearer for customers. So my view is that it's had a positive effect. It feels very embedded in the industry, not just in NatWest. And I think a slight irony now is now that it's so embedded, it's starting to surface some tensions between what's expected within consumer duty and some of the other regulations, be they Consumer Credit Act. And to me, that's a natural maturity of a helpful piece of regulation. And we're working them through with the FCA. An example would be overdrafts, where complying with consumer duty might sit slightly differently to, for example, some FOS rulings. But generally, I think consumer duty has had positive outcomes for customers.
So if I add, totally wholeheartedly agree with Mr. Thwaite in terms of the embedding of consumer duty, the positive impacts that it's had. I think we should be thoughtful about consumer duty not as a one and done, implemented on a day and it was done. It's about constantly learning, getting better. And what we've started to see is some thematic reviews also performed by the regulator, which is helping us learn about opportunities for further enhancement on things like vulnerable customers and supporting vulnerable customers as well. And then if I just bring to life one particular aspect linking to the theme right at the beginning around the regulatory reform too, what we're finding is we look at things like customer disclosure and customer understanding, and one of the themes around consumer duty is around customer understanding. As we've started to test our disclosures with customers, some of them are driven by regulatory guidance today. If you were rewriting those in a consumer duty lens and thinking about customer understanding, you would write those disclosures in a different way, in a more succinct way, and that's where some of the layering and simplification of the handbooks is a real opportunity as we go forward.
I don't have much to add, other than we always said that you can't really argue with a policy which says a good outcome for the customers. We want a good outcome for our customers. That's a given. I would say that we've really had to sharpen our act when it comes to communications. We've gone a long way on communications. We've reviewed every single document. We are much more forensic on complaints so that we really understand the root cause. And then even simple things like getting our customers involved much more. So we launched our new app this year and we got customers involved to help us design the app. So it was really much more user friendly. So yeah, I think it's been good.
Completely agree with my colleagues. Maybe only two small builds just for time. The first is the thematic reviews are really important. So consumer duty embeds us trying to improve and ensure we deliver good outcomes. But for example, looking at the advice and guidance role and how we help more people get advice and guidance, as we look at SME scale-up financing, if you look at, as we said, the mortgage and homes market, we won't be able to self-improve without those reviews. Yeah. And then the second thing, which I know we've talked about with this committee, but I am very thoughtful of, is a principle-based regulation with the way broader retrospective conduct regulation is being applied does create additional challenges for the industry. And what I've been most surprised by as I've come back into the UK and I'm most nervous of in this context is, does it really throttle innovation on behalf of our customers? And so how we really make sure we can move into the future with confidence and try and focus on our customers without opening up retrospective changes or reviews, I think is a real focus for the industry. And hopefully the committee's, I know, very alive to that, but is something on your agenda as well.
Look, I'm now going to adjourn, though, briefly for a short 5-minute comfort break order. on Tuesday, the 20th of May 2025. We were just discussing the consumer duty and vulnerable customers. I'm going to bring in Mr. John Glenn MP.
Great. Could I just build on the point that's just been made with you, Mr. Nunn, on the advice and guidance review? You all, I think, have said earlier you want that to be a productive piece of work in terms of allowing you to grow your opportunities. But in this outcome-based policy of the consumer duty versus a rules-based policy, isn't there a risk that if you don't have specific, clear rules around the advice guidance refresh, you're going to then, you or your successors are going to have the same problem, legacy issues, where somehow there's a retrospective application of the law, but somehow there is consumer detriment. And this has bedeviled this area for a long time. How do you see us resolving this in a way that is definitive, that allows you and your organisations to provide better outcomes through the outcome of that review?
That was very much what I was alluding to as a good example. I don't think consumer duty will help us solve the problem I think society needs us to solve, which is for those that most need advice around building their financial resilience for the future and today. You won't be able to change how we support those customers without a more specific set of changes around the current regulation, which is, as you know very well, RDR, and then looking at the new advice and guidance rules that would work. And when we look at society, as you know, broadly today, people with less than £75,000 to invest, which is the vast majority of people in the UK, even if you include their pension assets, which we're the second biggest pension provider in the UK, find it very hard to get advice. So they can't find that advice. And we really believe working, and we have been working in a sandbox with the FCA, working with the regulator very closely to say, how can we provide that advice safely, ensure good outcomes, what are the rules that we would put around that? And then what we're excited by is actually some of the new technologies and AI, which may be a theme for the committee to come back on, could really make that much easier for many customers to use to get better outcomes, to build their financial futures. So it's exactly where I was going. We do think in some of these areas we do need specific rules, and the rules would benefit from being reviewed based on what we've learned in the last 10 years of advice and guidance.
That's really helpful. Thank you very much.
Thank you. Mr. Stewart, Mr. Murray.
Thank you, Chairman. I mean, just a slight build on that. I mean, I do think, Mr. Glenn, consumer duty does help. We want a good outcome for the customers as well. Today, a lot of customers are getting their financial planning advice off social media. Fact.
Yeah, indeed. We're doing an inquiry. We're looking into influencers.
I think we're better equipped to do that. I'm also very conscious that 50% of the UK population today have got less than £1,000 of savings. So what we're really trying hard to do is encourage our customers into long-term savings patterns, to give them the confidence to, even if it's just a little, just save a little bit over the longer period. And I do think the moral compass is on us through consumer duty to make sure our customers get a good outcome. So I'm very much in Mr. Nunn's camp. I really think advice and guidance, and we have tripped ourselves up there before, but hopefully we're in a different place now. So I really
but you favour a more prescriptive outcome from that review to give you comfort going forward that you can extend those sorts of assistance you offer your customers in a more wholesome and full way.
I am sure we'll come on to branches quite soon. I want my customers to be able to walk into a branch, see the brand above it, and be comfortable that they're going to get good advice and guidance to help them plan for the future. And today I'm very restricted in what I can do with that.
Okay, Mr. Murray.
Thank you, Mr. Chair.
Just a few things where I totally agree with Mr. Stewart and Mr. Nunn, and a few things. One, on social media, 4 out of 10 people are turning to social media for this help and guidance at the moment. And
it's a bit random.
Yeah, we were quite shocked when we were.
And so the gap that's left behind needs to be filled, we think. When we talk to our customers, they are confused and they do want help and guidance. And so again, it's clear that there's a customer need here. I do think we need some scaffolding around the duty, because clearly the rules today say certain things. We need to either take those away or build some scaffolding around them. But the most important thing is the point that Mr. Nunn talked about, which is the sandbox, which is we should co-create this between firms, clients and the FCA together so that we build something that lasts for the future.
Okay. Mr. Thwaite, anything to add to that? Or
To get, I guess, the heart of the question, Mr. Glenn, is there will need to be some prescription and some guidance. Otherwise, the potential for risks will stop the broader providers stepping into the space, which is a market failure in my view, because consumers need good advice.
That's a really helpful, clear answer.
Yeah.
Thank you
very much indeed, very helpful. Dame Harriet-Baldwin.
Thank you, Chair, and I'd like to start with Mr. Marrow, if I may. It's month end, it's payday, and your systems go down twice in a row. And I just wondered how worried our constituents should be about the legacy systems that your bank and other banks on this panel have. Should they all be holding cash under the mattress, cryptocurrencies and other ways to get around the risk of having a bank account with a bank which unfortunately has an IT failure?
Mr. Marrow.
So I wanted to start by saying we're deeply sorry for the disruption that our technical issue on the 31st of January caused for our customers. We've clearly worked very hard to recover from that and make sure that we put the right steps in place from a remediation perspective for customers too. We've learnt the lessons and we're acting on the lessons, both work done internally but also with help from third parties as well. So, I think that's the first thing to say. The second is that we've worked very hard over many, many years to make sure that customer disruption is as limited as possible. And we've invested many, many tens of millions of pounds to make sure that our systems are in the right place to do so. And what we've been seeing is incident levels have been dropping. So 24 versus 23 are down 63%. And we continue to work hard to reduce the level of disruption that's there ever for our customers and make sure we put that right. From your point around, and then I think it's just worth clarifying, the issue we had on the 31st of January was not a cyber or a malicious act. And then we've looked very carefully at whether there are any linkages of these issues to anything to do with payday on the last day of the month, or to do with underinvestment in any technology and capability, and we don't find any correlation between those things. But we'll continue to work hard to make sure that the uptime for our customers remains high. And that is what we've been delivering. For example, in April, we had 100% uptime for our customers, and so there were no disruptions as a result of the issues we've seen on the 31st of January. But we've learned our lessons.
Again a month later, didn't it? I mean, what did go wrong?
We had a short disruption a month and a half later. It was in the middle of the month. But it was some delays rather than the nature of the...
So what was the root cause then, if it wasn't a...
So we've had a software issue was the root cause, and we've worked with a third-party provider that provides us with that software. We've learnt the lessons around that. We've put a fix in place that means that we won't have a recurrence. And then looking forward, there's a further enhancement that we're making, which is in the middle of implementation right now.
Mr. Stewart, you must sometimes lie awake at night and think there, but for the grace of God, potentially my firm could go. So what worries you most about your IT vulnerabilities?
So first of all, welcome the question. I mean, this is our biggest expense in business today. We are investing hundreds of millions of pounds in systems because the system makeup in a bank today, you've got some legacy systems and you've got some very modern systems. And it does keep me awake, but from a slightly different reason, because I think cyber security is now very much at the top of our agenda, and it does worry me because we can be attacked, and we are being attacked all the time. So the defence mechanisms that you put in are absolutely critical. What I would add to give some comfort to the committee is that I think the amount of money banks, all of us, will be spending on our systems is enormous today, and it has to be. It has to be, because our customers rely on digital technology all the time. And just to bring that to life with some data, I mean, across our group, we are processing 1,000 payments a second across the group. It is just enormous. And at the same time, every week, we're making 8,000 IT changes. Now, whilst all that's going on, you're working. It's got to work 24/7, 365 days a year for your customers. And we operate at 99.985 uptime. So there's just no excuse. We can't have downtime. Now, what I must add is that nobody will guarantee you 100% uptime. So the skill is how quickly can you recover. So every time something happens across banks, we do not celebrate. We go straight to read across. Could that have happened to us? Are we okay there? What can we do differently? That's always what we do, and we will continue to do that because our customers need us there 24/7.
But is it the old legacy systems that worry you the most, or the much newer software and threats like the quantum apocalypse and so on?
So the old systems are incredibly reliable. I mean, we are diluting the use of the older systems all the time, but as a ledger, they work very well. But all the time you're bolting modern technology on. And it's not a case of is one more acceptable than the other. Something can happen that maybe even takes you out for an hour. But if your customers are online for that hour, it's really painful. So it's always about the speed of recovery. And we have made really good progress on that over the last 2 or 3 years because we had quite a bad outage in 2023. So everything's about that speed of recovery and getting it as low as you can.
I'm going to move on to where we are today in terms of IT with artificial intelligence, and I think, Mr. Thwaites, you've highlighted publicly the potential for artificial intelligence to help your workforce be more efficient. Does that mean that you think it will reduce the size of your workforce over time?
So as I've said, we've said as an organisation a number of things around AI and the potential that it operates. I do think it will be a set of tools that have the potential to improve the productivity of the economy, improve the experience of our colleagues, but also improve the experience of our customers. As you'd expect for a regulated, highly regulated institution, we're taking, I'd say, proportionate steps. We're very mindful of concerns around data and privacy and ensuring that any data that is used in models is used appropriately. Probably worth the context setting for the committee. Banks and the financial services sector have got a long history in using models and data. So in many respects, and certainly if I look at NatWest and Royal Bank of Scotland previously, we've been using kind of what I'd call standard AI in our financial crime, credit, fraud models for quite a long period of time. We're now using generative AI. We're doing that to make our colleagues more efficient. So an example would be... So
specifically on the colleagues, are you expecting headcount reductions over time?
The way we think about it, and the way I've talked about it publicly, is we're putting the tools into the hands of our colleagues. We think that makes them more effective and more efficient. We've seen that through our software engineers who can be more productive in production of code. We've seen that in our relationship managers, which we talked about earlier, that can summarise contacts with customers. So we don't see a direct link between deploying technology and removal of jobs. What I would say is the profile of the workforce is changing a lot. We're now recruiting people who are specialists in AI, data scientists, digital experts. That's obviously a different profile of staff from which the bank was recruiting 15, 16 years ago. So really it's an addition to staff rather than a replacement.
Thank you. And then, Mr. Nunn, in terms of artificial intelligence, you just mentioned it in the context of the advice guidance boundary, and it sounds as though you're exploring the use of AI as a way of helping you give that extra advice to customers. Is that correct?
Yes, I agree a lot with my colleagues. Obviously, again, we've had over 800 AI models live for over a decade in lots of areas all the way across the bank, protecting customers from fraud and economic crime we talked about, better credit models, safe lending, monitoring of our own people. So it's a very, very broad-based technology that we use. When we look at large language models, the latest version that's coming fully into diffusion now, what we're most excited about is it can really help us interact with customers better. We can understand them, we can provide more personalised advice, and we can provide them a more joined-up experience. Now, at the moment, that's all done with what we call a human in the loop, an HTIL. So we always have one of our colleagues supporting customers. But one of the reasons I raised it in the context of advice and guidance is when you look at the specifics of a customer situation, you really have to join up a lot of information. And then there's a lot of education support to customers that's needed. And we think some of the large language model tools could be part of that solution. Enables people in their own time, at their own time of day, to talk to a large language model and really help get themselves in the right place so they can make the right decisions. Now we need to test it, as my colleague said, in the context of the sandboxes, and the technology is moving really quickly. So already, when we look at large language models, agentic AI, keep me honest where the committee would like to go on this, we typically implement multi-leveled agents where they are monitoring each other and ensuring very good outcomes. So it's going to evolve quickly, and we're excited about how we can help customers further.
Very quick yes/no, that Lloyds of London now offers insurance to cover malfunctioning artificial intelligence tools. Have any of you taken it out? Just a quick yes from anyone who has.
No,
nobody has.
And, and just on this issue, the risk of using AI and things going wrong is a risk, as that question highlights. Are you confident that the senior managers regime and the personal responsibility that they have in this will protect you from AI risks? Mr. Nunn?
Look, it starts with me under the senior SMR. All of the risks start with me, and on this one, all of my risks get delegated down through my teams.
Yep.
Hopefully what was just clear is when we look at AI, it's a tool, so it's normally is in the context of economic crime risk or operational resilience, so outages and uptime or conduct outcomes. And we absolutely have clarity of accountability down through my leadership team, but it starts and stops with me.
Okay. Mr. Stewart, anything different? Or
Chairman, I would just add that every time a new piece of exciting software comes into the market, the bad actors have got it as quickly as we've got it. No. That's where the worry beads are. It's in fraud, financial crime generally, money laundering. We have got to stay right on top of that. I'm same as Mr. Nunn. I'm the SMF1. The accountability starts with me, so we have to make sure we get it right.
Okay. Mr. Murray?
The buck stops with me. The CRO and the COO support me. So SMF4 and SMF24 are the key roles that will support me with this. But then, as Mr. Thwaite and Mr. Nunn said, models have been around for a long time, so we have a lot of frameworks in place to making sure that our enhancements to that take place given the different natures of risks that are emerging from generative AI.
Anything else, Mr. Thwaite?
Yeah, the senior manager regime is clear. The leader of the business is responsible for all of the risks, whether they're new risks such as AI or historic risks like credit risk.
Okay, well, thank you. Rachel Blake MP.
Thank you, Chair. We've had a discussion today about savings, and I wanted to draw your attention to the debate that's been going on in the sector about ISAs. And yesterday, the Chancellor said, I'm not going to reduce the limit of what people can put into an ISA, but I do want people to get better returns on their savings, whether that's in a pension or in their day-to-day savings. Mr. Stewart, why do you think she said that?
Well, thank you for the question. I think she's right to say that. I mean, I want our savers to get better outcomes as well. And for the avoidance of doubt, I'm a big fan of cash ISAs. And I also want to give our customers the choice of that product. It's a safe product, it's very, very low risk. A lot of our customers have got a low risk appetite. That's fine. But we are probably, again, I use that word chosenly, leaving value on the table. So again, there are products that we have got and we can offer that give longer term results or better results over the longer term for savers. With the right guidance and advice to enter into those products. They are there. But I really like the idea of having cash ISA. I think it's a very important product in the marketplace today. But at the same time, you're probably leaving over the long term a little bit of value on the table.
So you're a big fan of cash ISAs, but you are concerned about leaving value on the table, as may the Chancellor be too. So why do you think that the discussion around changing the levels has now landed with the Chancellor saying this, if there's a recognition and there's a wider concern about value being left on the table?
Yeah, I think it depends on what your particular appetite is for risk at that point in time.
The consumer.
The consumer, absolutely. So if you're in a slightly more mature consumer, I have got a very low risk appetite. So, I save on that basis. If you're in your 30s, you've got more time, you might want more risk appetite. So I think the consumer needs the choice, and everyone has got a different outlook on savings and returns. I think choice is very important.
Mr. Maru, I think you want to come.
Yes. So I'll just say three things and sort of amplify a point that Mr. Stewart made earlier. Firstly, in all this debate around ISAs, I think it's important for us to remember rainy day savings. 1 in 5 people in the UK, as the FCA just said recently, have no savings. So anything that can do more around rainy day savings, we've got a rainy day saver, helping people build a savings habit is sort of the first priority. Then, and we've publicly stated that there are around £430 billion, we think, in cash, both in ISAs and non-ISAs, where customers should think about whether they want to invest that money for the long term to enhance their returns, as long as they're willing to invest for the long term. And then we looked at what are the barriers for them taking control of their money and make the decisions that they want to. And the first one of those was the topic we discussed earlier around help, guidance, confusion, anything that can help them with simplicity of decision making. And then the second thing that we find from the research we've done with our customers is many of them think of investing as gambling. And so that culture of investing is something that we're going to have to build more campaigns around so that people start to understand the benefits of it as well as the risks of it, because at the moment a lot of people think that this is gambling. So this is an opportunity to take actually a more holistic view around the savings habit, as well as making sure that people have options in front of them for long-term investing.
Mr. Thwaite, do you think that the concluding on the advice guidance boundary review will be enough to change behaviour, or do you think there are other things, reflecting on what Mr. Maru said around culture and, I would argue, trust, in order to change behaviour?
I think there's topics to address around financial education, around trust and confidence in the advice system. I do think when we talk about ISA specifically, we should have a broader discussion, which Mr. Maru alluded to, around savings and investment. I think ISAs have been an incredibly successful part of the savings and investment landscape, but they are one part of a much broader landscape. So I think the Wealth Advice Review, incorporating views on ISAs, I personally share the view that there should be a component for cash, because it should be around customer choice, customer risk appetite. So I think it's a broad topic. Simply changing certain limits or levels isn't going to change consumer psychology. I think it needs to be combined with a whole set of initiatives around the pros and cons, the risks, the benefits, the rewards for investment. And I think the reality is, if you look at the UK consumer, there is risk aversion. So, and if you compare it to some international markets, that's very stark. US is the easy one to quote, but there's a much broader range of markets as well, where a greater proportion of savings and investments go into different types of investments. So, we're not going to solve a problem by fixing a limit in a short period of time. But I do think as a country and a society, we need a wholehearted approach to widening how we think about savings and investments and the benefits that they can provide in later life for people who are fortunate enough to be able to put money away.
Okay. Mr. Nunn, do you think it's just that it's an appealing consumer product, or is it a benefit to the banks to have cash ISAs with these limits in place?
Thank you, Ms. Lane. No, I agree with most of my colleagues here. Whether it's an incentive to the bank, let me answer that question first. It very much depends on the products. Actually, many times, taking money out of savings or deposits and putting it into an investment is an equal return to the banks. We can have the debate about returns on savings. I'm sure we've had that at this committee before. So there's not an incentive. Now, you need to get more specific. If they were to invest in an equities portfolio or an ETF versus a bond versus some kind of private credit product, you get very different economics. But for most people, as we said, most people don't have a significant amount to invest, and they should be getting, if they are going to go outside of cash, get into very simple products. Can I just make two more points briefly for the committee, and obviously any information we could share would be important on this. The first is, look, most people in the country, if they're lucky enough to have a home, that's their biggest source of wealth, number one. 7 or 8 trillion of wealth locked up in unmortgaged homes. The second is their pension, defined benefits or defined contribution. There's about 3 trillion locked up in homes. The third is typically, as Mr. Maru said, cash, but it's typically lower down the list. And their final one, Very few people really have a significant investment portfolio standalone, and if they do, they're in the top 5% by wealth. If we want to help the majority of the UK have better saving habits and take the right risk, you need to be talking to them about their homes, their pensions, their cash, and any investments. And pensions, we are the biggest default fund in the UK. Pensions have been a really important point of intervention in the UK in the last few decades, where we've moved towards contributions through employers and then a default fund which takes risk. And the opportunity to really help provide support to employers and employees to educate people and understand how they're taking risk and how that's helping them in the future, we think is really important. And it is, Mr. Thwaite talked about the US. The US spent 30 years under a 401k scheme which they introduced in the 1970s, which was a default investment under employers, to build that education and trust. So I think we need to just look at the broader range of interventions to support people and make sure we're focused, certainly from my perspective, on the 75 to 80% of people that can't afford advice and don't have hundreds of thousands of pounds to invest. The £20,000 ISA limit, Mr. Drury gave the data. In our data, less than 60% of people have £1,000 of cash. 75% have less than 5,000. The £20,000 limit is not for the majority.
Something that's going to be an issue. I think it's going to go on. The debate will rage for a little while longer yet. Yuan Yang MP.
Thank you, Chair. I'm going to ask about first-time buyers, and as we know, the number of first-time buyer mortgages has been at a 10-year low, and home ownership among young people in particular is also extremely low. And recently the FCA reminded banks of the flexibility you have in administering your stress tests and affordability tests. There are many first-time buyers, such as my brother in fact, who are being stress tested at interest rates up to 8% and possibly failing affordability tests for mortgages that pay less than their monthly rent. So in response to the FCA's kind of reminders, I wonder if you are planning to make any changes to your affordability tests, and if you see that there is a problem there. I'll start with Mr. Thwaite.
Thanks, Mrs. Young. We certainly recognise how difficult it is for people to get on the housing ladder, and how, when we talk to our customers, how desperate some of them are, not all, but some of them are to do that. In direct answer to your question, we have changed our affordability stress tests on the back of the new updated guidance from the FCA. That reduces the stress test by in the region of 2 to 2.5%. So that's now live and operational. For an average salary, I recognise it's an average salary, that would increase the amount of borrowing by around 30 to 35,000 for a first-time buyer. We've also introduced a family-backed mortgage that allows people to get on the housing ladder if they get support from family as well. So trying to support the first-time buyer market in a number of ways. There's also, as I'm sure you know, an ongoing consultation in terms of affordability, and I'm sure we're all contributing to that. I think there's further opportunities to look at various changes in the mortgage space, which would allow more people to remortgage easily, but also more first-time buyers to get on the housing ladder.
Thank you. And Mr. Marwood?
So I'd say three things, I think. Firstly, totally recognise the point about how difficult it is for first-time buyers. Our own data shows that the average age of our first-time buyers is now 34. 2 or 3 years ago it was 31. So we're starting to see that continue. And the key challenge there is the deposit. Of course, stressed affordability, and I'll come back to that in a second, but finding the deposit is probably the key challenge that people find, which is why we've done a lot around trying to help support first-time buyers with a number of products, including 100% loan-to-value mortgages with the help of others, income boosters, as well as taking action on stressed affordability, similar to Mr. Thwaite. That should mean that the typical borrower is able to borrow another £30,000. But it's the combination of how do we help support from a deposit perspective, how do we support from a stressed affordability perspective, and then over time to relook at the LTI, the loan-to-income limit, which is 4.5 times at 15%. As interest rates drop, it'll probably be helpful for us to start looking at whether that limit is right or not in the future as well. So a lot of steps that we're taking. It is tough for first-time buyers, but we are starting to see an increase in the number of first-time buyers. So certainly because of the stamp duty deadline, we saw significant increases in first-time buyers during the first quarter of this year. And what we need to do is to continue to see that momentum as we move forward.
And when we last discussed this issue with the FCA, they were concerned about the potential of over-leveraging first-time buyers and repossessions that might result from that. So I was wondering if anyone on the panel has a view about the balance that should be taken in this ongoing mortgage consultation. If anyone wants to. Mr. Stewart.
So look, I'm happy to join in. So not in the spirit of competition, but we're the biggest first-time buyer provider. We supported 65,000 customers last year and 20,000 in the first quarter. So just to support Mr. Maru, because of the stamp duty, we actually saw a very strong first-time buyer market. But I fully recognise getting on the housing ladder is difficult and very challenging in that context. We've also adjusted, as Mr. Thwaite said, our affordability criteria. We're not concerned that that's going to create the risk that the CEO of the FCA talked about, because they're still very sensible criteria, and we still see arrears at low and falling levels, low relative to history and falling levels. So I don't think we're at that place. I think the other thought here, and my colleagues talked about it, owning a home, again, isn't available to much of the UK. The average income is £75,000. That's either individual or joint income for owning a house. So we've made owning a home, for lots of reasons, unaffordable for many. So when we look at getting onto the housing ladder, we would really recommend, and this is one of the things we've started to talk to the FCA as they're thinking more broadly about the mortgage market, shared ownership, which we try and lead on. Can we create shared ownership structures where people can get onto the housing ladder and own a part of the property they're living in if they want to ultimately build their wealth? At the bank of mum and dad, as we just said, the average deposit now is £60,000. Our ability to help parents free up cash, especially if they want to use their own property, is very constrained by conduct rules. But the reality is that's a huge part of how families want to support each other. And so there's a real opportunity, I think, for us to think about home ownership in a more joined up way. And affordability, I think it was just a sensible thing to do. And I'm not concerned at the moment around where we're at, certainly for Lloyds Banking Group. But there really is a broader opportunity, I think, that we can work as an industry and with the FCA to go up.
Thank you. Mr. Stewart.
Yeah, I thank you very much. I think it's a really important question, Zhang. So first and foremost, as a banker, there is little that gives you greater pleasure than helping young people get on the property ladder. I came from a background where my parents never owned their house, and I always thought we should be doing as much as we can to get people onto the housing ladder. I really welcome the changes by the FCA, not least because we lobbied them quite hard for change, principally because of the colleagues' information. It's a low-risk sector, and we should be trying to help as many people as we can get onto the housing ladder if that's what they want to do. Again, just to repeat, many young people do not have the luxury of bank of mum and dad, and so raising that deposit is a real challenge. You're paying rent and saving for a deposit in a very difficult environment with low salaries. We take that very seriously, and I think the changes are most welcome. We'll manage to bring another 20,000 people into the housing market because of the changes. I think we're consulting further, which is good. I still think there's a little bit of elasticity in this market, but again, we really want to be leaning in and helping people to fulfil their dreams.
Yeah, thank you.
If I can just add one point, which is a different part of the debate. Yeah. Another way to help this situation is obviously around the supply side of housing and affordable housing. And I know it's not necessarily the focus of this committee, but I think it's important to think about that as well, how we can free up planning, how banks can support the building of affordable housing, and that will also create a greater number of people who can access housing. So there is another part of the discussion rather than just how do we make sure the existing housing stock can be purchased by the population.
I think my colleague, Mr. Dean, is
well, that was actually going to be my question, Mr. Thwaite, so perhaps I could ask it to you. Is there a concern that by delivering all of these demand-side measures while supply is still constrained, I know there's commitments to increase it, but there always are, that we could actually just simply be driving up prices over the medium run, and that makes it harder for the next generation of first-time buyers to get on the ladder? What do you think? Do you think banks should act with caution about increasing the number of demand-side measures while supply isn't proven to be increased?
Hence, Mr. Dean, my reason for mentioning it, I think it's important that we address the supply side as well. And I think there are policies that could be implemented to
So I appreciate that we should do
So
that
I guess
as
any-
well.
so
But
yeah,
I'm saying, do
you
you think
think
banks
about-
should act with caution whilst the
So I think the
suppliers
changes at the
continue to
moment are relatively modest. So I wouldn't, I wouldn't see direct causality in terms of a significant change to house prices. But if you take a step back, any market, if you increase demand and supply doesn't change, then ultimately that does lead to house price appreciation. But I'd just say the changes at the moment are relatively modest. What I'd call for is an integrated, thoughtful, holistic approach to home ownership, house building, to allow more people to either rent or own, depending on their personal choice.
But I guess it's not necessarily against the bank's interest, is it? Because I mean, if banks are still able to sell mortgages and they're going at higher rates, then you could still be getting a good sort of profit from the mortgage market. You're not worried about the market clogging up.
As Mr. Stewart alluded to, as a bank, we want to support as many of our customers as possible to buy homes should they want to do that. So the larger the mortgage market, the more that we will step into that. But ultimately, we're following what our customers want to do.
Yeah. Okay. Fine.
Thank you.
I'll come back to you just to be on the financial.
I was going straight to that. Fine, brilliant. Changing tack slightly, we want to talk about the Financial Ombudsman Services reforms. You'll know them, the changes to fees, the return of two-stage complaints, and generally making it harder for claims to come via claims management companies. There is a concern that some of these measures will weaken protections for consumers whilst making life easier for firms like yourselves. Why do we need these reforms? Mr. Stewart, perhaps I'll go to you first.
Yeah, so thanks for the question, Mr. Dean. And again, I think the FOS is due for a review. When the FOS first came into being, it was to look at customer complaints that couldn't be resolved by the banks up to a maximum of £100,000. I think the FOS has now turned into a quasi-regulator. Its remit has got very wide. And my biggest challenge with the FOS is I don't really have a right of appeal. There is an appeal process, but I've got to go through a judicial process, which is very expensive. And even then, it's then got to go back to the FOS for a second opinion. So I think the time is right for that review. And I say that based on some of the cases that I look at, some of the larger cases come across my desk, principally around fraud and investments. So I see a lot of crypto fraud. I see a lot of romance scams. And some of these numbers are hundreds of thousands of pounds. And we are told we've got to refund some of these customers. And I feel terribly sorry for the customers who have been put in a very difficult position. But I just sense the FOS's remit has got very, very wide.
What can I ask you about that? Because I know that UK Finance have proposed to remove the FOS's fair and reasonable remit. And my understanding of that is that if, say, an 85-year-old customer transferred £3,000 somewhere overseas, then it's probably fair and reasonable for you not have to investigate that. But if they did £100,000, then you would have to go and investigate that. But if we remove that fair and reasonable requirement, there'll be no obligation on you at all. That feels like a step backwards for tackling fraud. So what's your view on the fair and reasonable remit?
So let me explain what happens when we look at some of these cases. I would suggest about 95% of them, and I have to go and absolutely check my facts, but a huge number do not touch the sides. We have a look at it and go, poof, let's get the customer refunded. And that happens really, really quick. It's when it goes outside the remit. There's a case at the moment that I have written to the chair of the FOS on because I don't price for that sort of risk. So this is people who have invested in what I think is a high-risk operation. It advertised 30% returns. The customer has failed and people have lost their investment. We have been told to refund those investments. That's going to total about £4.5 million. It's not even that case that I'm concerned about. It's that if we've now got to refund investments that have gone wrong, I don't price for that.
Okay, but
So
can I
I've got
just
to
get a
rethink.
quick answer on what your view is on the fair and reasonable remit? Do you think that should go?
I think fair and reasonable is a reasonable statement to have in anything. It's fair and reasonable. It depends on the circumstances.
You would keep that?
I would keep fair and reasonable.
And Mr. Mariano,
I'd just say a few things. Firstly, we have no desire to weaken customer protection. To the example that we're just talking about around fraud, the PSR rules are in place now. I think we saw the data only recently around people being refunded. I think it was 86% for the industry. Ours are higher than that. And so we are delivering good outcomes for our customers. Modernising the FOS, I think, is a good thing to look at and do. Go back to what it was set up to do, focus on simple cases, and then allow the FCA or the courts to deal with the more complex cases where FOS is getting bogged down. So I think that's our thought and view around the Ombudsman and modernisation of the Ombudsman.
Okay, thank you. I saw Mr. Nunn wanted to come in.
No, I was going to say the same. Look, we really believe we need a healthy FOS that provides quick, fair answers. It's not been able to do that for the reasons that some of my panel colleagues have said. So we really believe we need a FOS that makes quick and fairness-based decisions. On the fair and reasonable, which is, I know where you were pushing rightly, I think it's important to look at the definition of fair and reasonable. We want individual customers to be able to go to a free service that gives them a quick answer, and that's what we think the industry needs. And today that's not really what's happening in lots of cases. So we really welcome the review, and we absolutely, I think Ms McDonough raised earlier, our industry is built on trust, and one of the reasons we believe the FOS is important is it enables individuals to get those quick, fair answers, and that's what we'd like to see.
Obviously, there's going to be a change in leadership at FOS by the autumn, so I'm sure next time you're in, you'll have things to say about that. John Lennon.
Yes, I turn to financial crime. I think we're quite alarmed. The FCA said that that's one of their top priorities in the next 5 years. They just see is about having slower growth. Now, you have all collectively had to implement the authorised push payment reimbursement scheme, I think, over the last 7 months. Now, I seem to recall there was a collective frustration with the disparity of the way that regulators, government dealt with you as banks and your culpability, with the way that they dealt with tech platforms and firms. And the desire to avoid offending such great institutions that make so much money for the economy and are linked to our relationship with the US and all the rest of it is probably that all governments are reticent about doing this. But for clarity, can you tell us how you're getting on with the reimbursement model? And when you look at financial crime, how do you see it going forward? And what would they need to do to bring some sort of clarity on this issue to deal with the fact that you aren't the only ones culpable in this space when it comes to financial crime? A massive concern for so many who will be watching and on reports of this today. Mr. Thwaite, thank you.
So couldn't agree more in terms of the issue around economic crime. The statistics for 2024 are quite alarming. 1.2 victims, up to £1.2 billion, £2,300 a minute. It's unbelievable, the numbers. I think if you look at the crime statistics, just less than 40% of all crimes relate to financial and fraud. So it's to me, it is a massive issue for the UK. Last time at this committee, I guess I made a plea for a coalition of the willing. That was the tech companies, that was the telco companies, the banks and the policymakers. I make that plea again. While some progress has been made, I genuinely believe we need to do more. When I share those numbers, to me it brings to life how significant an issue
What specifically would be?
So I think there's ideas around data sharing. There could definitely be data sharing between all the parties, and we need to make sure we've got the right protocols and permissions around that. But data sharing.
But that's always seen across Whitehall as a too difficult thing to do.
Yeah.
I mean,
but I think
is it realistic though?
I think there are aspects of it that can be done. If you look at over 70% of fraud originates upstream on social media.
Yeah.
We've worked with some of those tech companies and social media companies closely, and when you get very targeted and look at particular sites that are driving fraud and share information, we worked with Meta, we brought down a whole host, as an industry, a whole host of sites. So it is possible, but you're right, you have to take it from a generic kind of principle to some very clear specifics. But I think we need everybody to step up to the party because the impacts are really significant.
Okay.
So I'd agree with Mr. Thwaite wholeheartedly. Obviously, it's a material issue from a societal perspective. There's been a lot of focus on reimbursement as part of the PSR rules. From what I can see, it seems to be working fine and well and delivering good outcomes for customers. But we need to move the agenda onto prevention and detection, and that's where we talk to our own customers and we ask them about tech companies. 3/4 of them say tech companies should do more. 64% of them say they should actually contribute to the reimbursement scheme. So I think that's one possibility. And then finally, Mr.
Why
Waite
do you think
talked
they
about
don't at the moment?
they don't contribute anything at the moment.
Why is that, do you think?
Because, leave that to your imagination, I think.
Right,
and then I think the data sharing is important, the other opportunity, because if we look at investment scams, 52% of them are turning up on social media sites. We see pictures of people, using AI-generated images, etc., and I think there's a real opportunity to do more around identifying sellers and those sites more carefully with greater identity checking.
Thank you, Mr. Mayor.
Look, I think the point's been well made, and I know the committee knows the stats, but it is really disturbing because, as we've talked about, the individual cases are harrowing. We said last year when we were with the committee, if we focus on what we pay back to customers and not on prevention, fraud will continue to grow. It has been grown. Attacks are growing. 76% of them are being enabled through tech companies, 16% through telcos, and the controls and our desire to work with them aren't working. And these are customers in that context, on social media, on different marketplaces. As you know, 60% of the total is with a single company, Meta, where customers are convinced to do something. They come to us with their credentials, with their passwords, and ask us, after sometimes many conversations, to move their money, and they think they're doing the right thing. If we can't intervene upstream, or if those players aren't incentivized to intervene upstream, this problem is going to get worse for the UK. And as we said last time, the UK has become the home of fraud. And that's something I know we all wear very, very uncomfortably, not because of what we need to do, but because our customers are going through that attack. And it's increasing year on year. It's up to 43% of all individual crime, based on my stats, is now financial fraud, if it were logged.
Thank you, Mr. Nunn. Mr. Stewart.
Yeah,
anything additional?
Just a couple of points on that, Mr.
Thank
Bennett.
you.
First of all, if you speak to customers who have been the subject of fraud, you will find very, very disturbed people because it's so invasive.
Yeah.
And that should be a concern to all of, and it is a concern to all of us. But we aren't the root cause, but we have a part to play. The glimmer of light I would give on this is that technology is helping. There's no question. We've invested over £200 million in fraud technology in the last 5+ years, and you can see it really starting to attack some of the known problems, so we can intervene and stop. And it's only recently we've had the power to not make a payment. So if you listen to some of the taped calls, you can hear customers going, the payment's got to go, it must go. We can step in and go, we're not making the payment. Things like that really help.
Thank you.
Thank you very much. Dr. Jeanson.
Thank you very much, Chair. Mr. Stewart, I'll direct my question to you. I think it refers to the whole panel. You're all doing really, really well. Your profits have increased by a huge amount, I think on average of 25 billion between 2018 to 2021 to 45 billion in 2024. Collectively, I think you're set to make a 14% increase in profits this year. To Mr. Stewart, what's going so well for all of you?
Well, one of the reasons that we've managed to make better profits in recent years is a really rigorous control of costs. We had a very high cost base and we got to work on that, so that's point one. The second point, we've expanded in the markets where we have done really well, or where we think we've got a right to win. We've done very well on trade, we've done very well on payments, and as the economy rises, we rise with it. We're in over 50 markets, and we're very powerful in some of those markets. So good customer service, good products, fairly priced, and really labour on the basics has really served us well.
I think it's something like a 70-odd% increase in your profits in 2018 and 2023. Is that solely due to cost control and customer service?
Well, I think at the same time you were coming through a very bad patch. So if you look at what happened through the pandemic and then out of the pandemic, so we had very low profits in the pandemic, 2020, very low, and then built back up from there. So I think that the global economy recovered, and we are a recipient of that economy.
Well, I mean, between 18 and 23, right, so the pandemic has taken out of that particular comparison. But the net interest margin increased a little bit, but not a huge amount across the sector. So why are you getting some increased profits of there it doesn't seem to be the main source of your profits. Would that be correct? Is that your understanding?
Well, can I just pull the conversation back a bit? Because we have to make good profits. We must try and get a return on capital employed. We carry massive amounts of capital. So, you know, we are in many markets deploying that capital to help our customers, and that generates the profits.
Oh, sure, that wasn't the question I asked though, but I'm okay with you guys making profits. I think it's perfectly reasonable. It's just the huge increase that we've seen, which is more that I was getting to. So the slight increase in net interest margin that you're seeing leads to a little bit of your profits, but probably doesn't explain the, what was it, £20 billion increase on average between the big four, between 18 and today.
So I think scale plays a part, and the way we've gone to market really plays a part. We've also been aggressive in our growth strategy, lending more money, bringing on new customers. So that's all. And your numbers are over quite a long period. And I would suggest before that, if you look back, we could not get a 10% return on capital employed. So I would say our profits previously were too low for our shareholders, for the amount of capital we had in the business. I think it's regulating a little bit now. We need to be at 13, 14%, otherwise we won't get investors coming in.
Any other witnesses?
If I could maybe just do one more question and come into the other witnesses. You all hold collectively a lot of assets in the form of Bank of England reserves. In 2021, obviously, you received a huge amount of these assets during COVID, and there's been a huge expansion of it overall. There's an interest paying around £20 billion to your four banks. I think the interest payments you receive increased by 135% since 2022 and 2023. Do you think the windfall profits or other windfall payments you receive from the Bank of England has somehow fed into the huge increase in profits that you've seen? Maybe start with Mr. Nunn.
It's interesting to know the bankers get their pens out when you start mentioning numbers.
Well, no, it's just really important for us to make sure we listen. So first of all, obviously the Bank of England and what we're required to hold with them, and then any interest we get. The interest amount is a political and the Bank of England decision, so I'm not going to comment on whether that's right or not. But in terms of those actual numbers, they're included in the net interest margin that you talked about. So that would be incorporated. We have a very bluntly complex way of calculating net interest margin against all of the deposits and where we put them in multiple forms, sometimes through the third-party markets, sometimes at the Bank of England. That's a very small percentage, by the way, for us. But also then what we lend out, and it's the net across all of the assets, all the duration that gives you the NIM. So that's actually included as part of this. And obviously how we support the Bank of England, often when they look at their liquidity schemes and they look at how they ask us to participate, we obviously often participate with them around those schemes at different moments in time. Through COVID, there were a set of number of programs which were very important for liquidity and quantitative easing that they asked us to participate in.
So some of the question really asked about some of the payments you're receiving from the Bank of England, there's a huge increase in profits seen over this time. So I'm struggling slightly to understand where the source is. No, I'm sure cost control is great, but across all four companies,
well, maybe
it's quite a lot.
Come back to our version of this.
Mr. Thwaite.
Oh, sorry.
So I think it is important around the context. It was a long period of time since the financial crisis where banks couldn't earn their cost of capital. That's bad for a number of reasons. It's bad for shareholders. It's very difficult to attract new shareholders. It also means it's harder than it should be to support customers. So I think what you have seen is a more regularisation of profitability. I wouldn't agree it's just around costs. I think if you look at the P&Ls of banks, you can see that revenues have increased. That's because of more lending, whether that's more mortgages, more business lending. I know that's certainly the case for NatWest. Costs have been managed well as well. Capital has been managed well. We've also had relatively low costs of impairment. I think Mr. Nunn alluded to that in the context of mortgages. So I would look at profitability through all the lenses of the P&L, and it's all contributed to an improving operating profit position, which I share your opinion. That's a good thing. That allows us to invest in services for customers. It allows us to support customers with capital. It also allows us to return money to shareholders. And a strong economy needs strong banks and vice versa. Reserve remuneration, I think the debate around that, you need to consider that is a key part of monetary policy, and it's not unusual when you look across a whole host of different countries. It's a way in which, I guess, the bank rates and market rates are aligned. And I think what sometimes is forgotten that, as we go into a lower rate environment and as reserves are taken out of the economy through quantitative tightening, those payments will reduce as well. So there's a lot of dynamics, but ultimately, as Mr. Nunn said, that's a Bank of England and political
Well, a lot of payments still to cost, sorry.
I was just going to add 2 points because I won't repeat the other points. One is from a Barclays perspective, our return on tangible equity, which is what investors use to judge us, in 2024 was 10.5%. So that's still below the cost of capital. So our investors, are continuing to obviously expect us to improve the returns that we make. We're focused on growth as well as serving our customers as well as possible. And then the second thing, which I think has been alluded to, it's really important to judge these things through the cycle. And so we have a period where arrears rates are very low, partly thanks to lots of good work that's been done, but it's important to judge it through a cycle as well.
Thank you. Thank you, Chair.
Very much. Just a couple of hopefully quick answers. They're fairly straightforward questions. We talked earlier on savings. We could talk about that a lot more, but the lifetime ISA, we talked about home ownership mortgages too. NatWest provides a lifetime ISA. The other three of you do not. So perhaps you could just explain briefly, Mr. Maru, Mr. Stewart, and Mr. Nunn, why you have not chosen to go into the lifetime ISA market, Mr. Maru.
So we look at whether we should or shouldn't, and we're actively looking at whether we should enter the lifetime ISA market. There's obviously some uncertainty about what may happen from a ISA simplification perspective. And so I think once that debate is concluded, we will work out where it fits in the product range. There is obviously, we have.
But you haven't gone into it before now. I mean, so it's been around for a
while. We had the Help to Buy ISA prior this as well, which obviously was helping first-time buyers. That's gone now, and so that's why we are.
So you lent into the Help to Buy ISA rather than the lifetime ISA.
Indeed, and then I think from a customer confusion perspective, there are a number of choices: innovative ISA, the lifetime ISA, the cash ISA, the stocks and shares ISA.
So you basically, but just to be summary, you chose to go for the Help to Buy ISA rather than lifetime ISA. Is there any particular reason?
And we are looking actively at whether we, enter the lifetime ISA market, subject to it still being there.
Okay, so you are still considering that as an option. Okay, Mr. Stewart.
Yeah, thank you very much. It is an option. We don't have it today. Quite simply, we think we've got better products. We think we've got better products to give a better return. It's always there in our thinking, but and just right now, we think we've got other options that suit the customer better.
And is there any? I mean, you're obviously leaning into other options rather than lifetime. So, is there a particular aspect of the lifetime ISA that you don't like?
Yes, there is one actually, and that is that should you break the ISA, the break clauses can be quite heavy. So that we always get nervous about that because I think, how do you explain that to the customer? So we've just taken a back seat on that one at the moment. It's always there, it's always on the radar, but at the moment we think we've got other more suitable products.
And Mr. Nunn. A complication too far on top of motor finance, perhaps.
No, let me be more specific. This is a relatively complex product for the people it's targeted. It's targeting people for 3 to 5 years, typically when they're building a deposit for their home, but it's limited at £450,000, and we see people go over it. And then it's targeting people at their pensions stage with a very punitive 25% out. £100 plus 25%, minus 25%, you lose money. So we are very concerned about it from a complexity and then a conduct outcome, number one. Number two, if you want to save for returnement, there's other options which are better, so you can put into your, for example, workplace pension.
So it's very from you, it's a definite decision.
Well, at the moment it is. We think those two needs are really important, helping people with their first-time buyers, building future retirement. Future retirement pre your income tax, if you pay income tax, is better than the 25% bonus. How do you help people safely make that choice? We have very, very high obligations on us, as you know, and you rightly challenge us. So we just are nervous about the design of the product as it stands, and we think there's better alternatives.
Well, clearly
but we'd love to revisit it.
Lots of discussion going on in the government, obviously, about ISAs, as Mr. Blake touched on. And then finally, you've all had your interest rates on your instant access accounts have reduced since the bank last cut the bank rate. Have your mortgage rates decreased similarly? We'll start, Mr. Nunn, and go along the way.
Yes, so split mortgages into two buckets. There's those on variable or trackers. They happen almost immediately. Interest rates on savings, by the way, as the rates have come down, we're passing less than 50% on, and there's a 60 to 90-day window where customers can respond and choose, as you know. And then on fixed rates, which is where the majority of the market is, as you know, we have to actually, for prudential stability,
keep them fixed,
Well, and keep them fixed, and then for those repricing, they're typically looking for rates based on 2 and 5 year forward rates. So it's not linked to the base rate.
Mr. Stewart?
Yeah, so firstly on mortgages, pass the rates on very quickly. It's a super competitive market. We like the mortgage market a lot, so we want to be competitive in it. one mortgage product, if I could just explain, our standard variable rate. During 2023 to 2025, we put a cap on that, so as rates were rising, we did not want to have a 7 at the front of that number. We never went above 6.99. We've just started to reduce that as well, but we really want to look after our customers through that period, so we'll have another look at that in the weeks ahead.
Okay, that's helpful and interesting different takes on it. Mr. Maru.
So just echo the points from Mr. Nunn around how the mortgage market works. Also 300 mortgage lenders and about 80% of it through brokers, so highly competitive market from a mortgage perspective. And then on the latest rate cut, 25 basis point cut, the main products we've seen a 5 basis point cut, so much lower than the 25 basis point reduction.
Mr. Thwaite.
Yeah, simple answer. The pass through as rates have gone up has been the same as come down on the savings side, and mortgages on the base rate
and at the same time frame.
Yeah, correct.
Okay, thank you.
Well, there are some product.
Well, obviously, yeah, and
some
we appreciate
product requirements in terms of notifying customers, but there's no disconnect between the up and the down.
I mean, the obvious comparator is the standard variable rate.
Yeah,
obviously
and
the other products are a bit different. Finally, one quick question, I think, from Ms. Yang.
Thank you, Chair. And Mr. Stewart, congratulations on your recent appointment to HSBC Holdings as a Group Director. I hope that you can convey to your new colleagues in HSBC Holdings how deeply concerned I am and many of our committee members are about the ongoing withholding of pension payments to Hong Kong BNO nationals who are now settling in the UK, of which HSBC Holdings has about £1 billion held, which under present circumstances will never be withdrawn. We really want to see progress on this issue, and I think it's disappointing that HSBC Holdings has not yet appeared in front of Parliament to speak to MPs on this issue. So I ask if you can convey that, and if you can make some commitment from HSBC Holdings to answer questions on behalf of MPs.
Yeah, so first of all, I'll take the question because it's a really important question. Obviously, we've got a lot of Hong Kong people settling in the UK. First of all, thank you very much for your kind remarks on my new job. I've not started yet, but I'm excited about it. This is a really difficult one for the bank because we would have to break the law to pay the money. The law in Hong Kong states what we can and cannot do, and we have to obey by the law. We are a visitor in every country outside the UK, and as a good visitor, we always obey the local laws. So unless we break the law, there's very little we can do right now. We are hoping that government influence, etc., may change that, but at the moment, the law is the law.
Thank you for that candid answer, and I'm sure that will be taken up elsewhere. Can I thank our witnesses very much indeed for their time. There's so much we could cover, and we hope that you will come back again at some point. Tomorrow we're seeing building societies and some of the challenger banks, just to get a general landscape for the British public who we represent and who you serve, an idea of what's going on in the banking world. So can I thank you very much indeed for your time. The transcript will be available on the website uncorrected in the next couple of days. Thank you very much for your time. Order.